Omega. We had that webinar presentation from them on Monday afternoon, and that was pretty much what we were waiting on. Since on the other side of that, when I start running all of my automatic strategies and we go back and rebuild them and test them to work in today's modern world, when people start asking me, hey, how do we use this thing? I'll be able to just refer you to the webinar. Of course, that wasn't the only place to get information on that. They have their own YouTube page, and he has plenty of walkthrough videos on how to use the platform. The main thing is going to be taking my mechanical systems and then running it, rebuilding it, and making adjustments so that those mechanicals will work in the current environment. And then, of course, discussing how the current environment has to be monitored, because at some point we will go back to the way things used to be eventually, someday. It's been a pretty busy week, and my call out for that live stream has been Friday afternoon. So far, that hasn't changed. So that's what we're going to be looking for. Now, next week, since this week was a short week with a holiday, I'm only going to do 1 week, or 1 day. But next week we'll be back in regular mode, and I will do probably 2 a week. The idea would be first to kind of explain, say, what the global standard is around the world for a typical iron condor, just for an example, right? Say a duration iron condor. We would talk about the gold standard used around the world, and then talk about how we could mechanize that, and then go through the testing process to see, say, what strikes we should use in the current conditions, how much credit we should get as a minimum tax to open, and then what kind of targets we should use to exit the trade. Before COVID, I had all of these metrics, and I ran a mechanical trading system for more than 12 months, and it was phenomenal. It was absolutely amazing. It didn't matter, if it was a down day, an up day, a good week, a bad week, as long as the overall general marketplace continued to function normally, those strategies were phenomenal. Little to no technical analysis required, automatic systems that were just, the trade was placed because X, Y, or Z happened, and then you would take it off when it hit targets. Just, you couldn't ask for something better than that. But after COVID, too many things have changed, especially the volatility. And so that kind of breaks a lot of those automatic trade systems. And I continue to hear people say that they've been trying to trade, say, Tasty style, and they complain that it doesn't work. Tasty style does work, just not in the current environment, right? They've focused on 20 years of back testing to look at what works most often. But as soon as you get into an extreme environment, when you are no longer dealing with a normal market environment, their stuff doesn't fit. It's just the way it is, right? So uh, it'll be insightful and profitable to rebuild these things, get them functioning in our current climate. So that'll be Friday afternoon. I don't have a time frame yet. Still got to look at the calendar and see what's going on. But yeah, I had to start a little early just to make sure my systems were functioning the way they were supposed to. So it gave us a minute to talk about this stuff anyways. All right, so let's go ahead and get started. Like we usually do, we want to take a look at what happened in Europe, right? It's not done yet. It's midday in Europe, but we also want to see what happened in Asia, which sectors are doing good, which ones are not doing good, and then take a look around to see if there's any extreme news that stands out. Now, that extreme news, I've had people bring up like a bunch of odd junk. Hey, is this what you consider extreme news? Look, you'll know it when you see it. You don't have to try to invent something or make something up. When that ship was stuck in the canal and it backed up world shipping lanes. That was a really big deal, right? It will be something blatantly obvious. So if there's nothing there, there's nothing there. Just let it ride. There's no big deal. I'm looking at Financial Juice. I am signed in, but I don't have like a paid account. This is a great resource and it's free. Um, One thing that I would recommend is use the filter so that you can eliminate things that maybe you don't want to see, because it'll pick up news from like MSNBC and Fox Business, and you can go in and weed out some of the posts to maybe eliminate sources you don't appreciate. There is a lot of traders, and this is a little bit of information that used to drive me crazy. I would spend a good chunk of my morning, oftentimes, trying to find who's going to be speaking today and at what time. Drove me crazy. And yet, if you just go to Finance Juice and you look on the left sidebar, you will see where there are speakers listed. Now, that doesn't mean that that's all the speakers. When the S&P hit that 20% bear market trigger on a Friday afternoon in May, we had one of those Fed speakers. The guy is a part of the plunge protection team. He just randomly popped up on Fox Business, started chipping his teeth, and spiked the market into the afternoon. And he was not listed on here, right? So uh, you can have random speakers just show up, but at least you're starting the day with an idea of what's on the books, right? We can't deal with random until random gets here. We can at least have an idea of what's supposed to be going on today. The president is on schedule to speak today, too. If you look in the Bullish Bears stock and options channel, I posted the list of speakers and the president's 2 o'clock speech. He's going to talk about the gasoline tax. Now, the oil did respond to that news, but I'm seeing it like a snowball's chance in hell that we're going to get anything out of Congress. What, that they're going to actually work together and make a vote on something without everybody trying to pad that bill with their own little favoritisms? Nah, I don't see it. But either way, you got to sell off in oil. That may be a nice validation for a pullback play. Either way, bonds are waking up and making some moves to the upside. Gold, which is a reflection of the inflation hedge. Remember, you got to add that word inflation, because I've had people say, oh, gold's a hedge trade, right? No, it's not a hedge trade. It's a hedge against inflation. Big difference. All right, so looking around, nothing extreme popped up. I did see that President of China will step up anti-monopoly regulations over platform firms' state media. So not sure what that's going to do, but when they cracked down on the tech sector, for an example, it had reverberations in everything. We've seen the beatdown in JD and Alibaba and Baidu, and it was a list, right? So you want to keep your eye on what's going on with the Chinese president and anything that has to do with crackdowns or regulations and lockdowns, right? They're still having isolated lockdowns. All right. So we go to Market Watch, go to the calendar. When you're on Thinkorswim, consider these different menu sets. So you have your top menu set, and then you have your second tier menu set. So you want to go to Market Watch, and then you want to go to calendar. And from there, if yours is really cluttered, say it looks like this, the easiest way to get rid of it, just turn everything off and then turn on Econo Day event. The description can be moved around. I like to just set it next to the clock so I can see what's going on. 8:30, 9:30, 10 o'clock, and 11:30. We do have additional auctions today. Right now, there's a bond auction of the 2-year floating rate at 11:30 and the 20-year bonds at 1 o'clock, and it didn't show up in here. That's okay. I posted that too. It's in stocks and options chat room. So be prepared. I know that these don't show up as highly impactful. If you were to go to like FX Street or something like that, they try to rank the anticipated impact of these auctions, and it's always shown as really low. And yet, it's often the source of being able to catch V bottoms or even, blow off tops in the market. Those midday reversals that I love so much. So watch the clock. 11:30 and 1 o'clock, and then you got the president at 2. Powell is going to be in Congress for the next 2 days. Well, the Senate Banking Committee, blah, blah, blah. Right? So he will be chipping his teeth. But for the most part, it's going to be Operation Don't Rock the Boat. His intention is going to be to not say inflammatory things that will move the market. Right? Now, that doesn't mean that he won't. Before this taper, the last time we tapered, there was a member of the Fed at the Senate Banking Committee chipping his teeth, and he made it slip that they were talking about tapering. And oh boy, there it went. Right? It was just the market reacted crazy wild. They tried to walk it back and they couldn't. The genie was out of the bottle at that point, and it was just madness and chaos. So, yes, he can screw up and nibble on his toes when he puts his foot in his mouth. So it is important to realize when he's there talking, you have to be on guard. You need to be alert because he could say something inadvertently that rocks the market. And that sucks because he's going to be in there basically all morning long, just wasting our trading opportunities. So I'm not going to say something like, well, you shouldn't trade, or, you need to avoid trading during it. That's not for me to say. You want to trade it, go get it. Just, be mindful that if you get ran over from some random spike ride that comes against you, you can't say, "Oh, I didn't know he was in there talking." Keep making excuses. All right, so what are we dealing with today? We got the S&P down 1.25%. It is up off of those lows quite nicely, I would add. We were down more than 2%. So the fact that we're only down 1.25 only, it's not that bad. That actually gives us a little bit more to work with. Do be careful of these liquidation breaks. So when you have a market that does a liquidation break like that, very often it will come back up to where the liquidation break began. And then if it wants to maintain its bearish posture, whatever caused that liquidation break, we would then see the market continue that bearishness, right? So the pullback that we have after that liquidation break is very often just trying to close a gap. And yes, I know there is no gap, right? You see candles there. I see candles, Sig. I don't see a gap. Whatever. It's a liquidation break. Imagine that there is no candles because this is trying to reset liquidity. It caused a vacuum behind it, right? And the vacuum needed to be filled. So it came back up and it filled that vacuum. So we could very easily continue this bearish posture. Yeah. All right, zones. Get rid of all these fancy lines. The yellow line that you see here, that is the 4-period daily moving average. When we are above the 4-period daily moving average, we are bullish. And when we are below it, we are bearish. We don't tend to get very far away from it normally before we pull back the other way. So when we're above it and we're moving farther away from it, we want to keep how far away from it are we? Now, the 4 isn't the 10, right? And the 10 is normally where we have that discussion of have we gone too far? It's not like that. The 4 is more momentum based. How much momentum is in the market? How much momentum does this move have? I use words like surge when I put together my 4-8 pairing group. That's my surge averages. Whereas something like an 820 is more of trend. But right now we are tangled up in that 4-period moving average. And when we get rid of it, we can see that there's an orange line right there. The orange line is half of the ADR. So this 21 ADR, it starts measuring at the Globex. So if we were to go up half of the ADR and down half the ADR, we get the full width of 2.78%. That's how far we traveled. But if we were to take the entire ADR from that Globex open and measure in one direction, that would be the orange line way up here and the orange line down here. So it's 36.63 to the downside and 38.70 to the upside. If we were to make an upside ADR, that would get us through Wednesdays, and Thursdays level. Is it possible? Well, we're going to spend half the morning doing nothing, waiting on Powell. So if it was going to make an upside move like that, it's very likely going to be in the afternoon, and it will be one of those rip your face off extreme rally kind of things. So it is possible, but everything would be lit up, right? There would be nothing subtle about it. Tick, trend, AD, vol, market breadth, all of that would be lit. So just kind of keep that in mind. So what's more likely? Well, we got the downside of this. Now we're already completely outside of, or we were, inside day breakout of Tuesday's level. We're back inside it now, where we're teetering on the edge of being back in and out, right? So that's a little bit of a Busby play. And it's also the trade setup, inside day breakout. So we want to see how this resolves this issue. It would be, when we think about likely scenarios, the most likely scenario is that we maintain the range at least into the afternoon, that we stay inside of yesterday's range. If we do that, it will be a lot easier to trade because we can focus on all of the institutional pivot points that we would normally use. Globex low, the open of the Globex, which tied in really nice with the open of the RTH. So I'm not going to mark that one. Normally we would. The Globex high and the high of yesterday, right? Each one of those providing another pivot point that we could see a reaction in the market and have a trade play. So if we do go back inside the range, at least we have benchmarks to lean on and targets, goalposts. For a downside play, we would want to look back to Thursday and Friday, mark out those same pivot points, and then really focus on the absolute low of this zone or this range that we're looking at. So the chart we're looking at is a daily chart. It's a year-to-date daily chart. We want to continue to focus on those swing highs and swing lows. I've seen a lot of traders kind of not necessarily buying the dip, but if I was to make this chart a little bit bigger, say 1 year or a 2-year, we could be coming down into a structural low where it makes like this really, really big double bottom looking thing. A lot of markets have that right now. And I've seen a lot of people buying it. Disney is one example of that double bottom, but MRO, a lot of names, just a lot of names of that really, really big double bottom. It's not a buy just because, right? Now, yes, you're at a structural level. It looks like it, would be a buy. And if we weren't in a bear market, I could say, yeah, I can argue for a buy. But we're not in a good, strong market. We're in a bear market. So you don't just instinctively buy this, right? The trend is down. It's obvious that it's down. We did print in a swing low. We very likely are going to get some form of a swing high, but that swing high can get muted. It can get shunted and trapped. Right. So even if we were to get that breakout, which we didn't get, but even if we were to get it, we're very likely not going to be pushing into 42, 43, 44. It's going to be more like 39 or 4,000. And we didn't get it. There's still a lot of negative gamma out there. Now, the move that we were seeing yesterday, that kind of extreme explosive move, that was a lot of short squeeze and shorts covering. So, just a little bit of insight on our expectations for today. So right now we need to resolve this first before we resolve anything else, right? Looking at the 10-day, 30-minute, you can see that the volume profile is very narrow right now. We're sitting with the bulk of all of the volume in this lower area, and that makes perfect sense, right? We got this shallow area, which is where price is at right now, right there in that shallow area. There's a little bit of a support, which price seemed to have found a little bit of a handout. The point of control is over our head. We are in the box though, right? Can't tell you how many times in the last 3 months that we've brought out the volume profile and we're outside the box again and again and again. So today we're in the box. When we're at the low, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're in the middle. We didn't get to the top before we started going down, and we didn't get to the bottom before we started going up. So we're just sitting in the middle. We want to see a resolution of the point of control and then a break to either side of this box, 38.30 or 36.53.57. Looking at the 5-day, 5-minute, what we call mapping out the 5 by 5, there was an untouched point of control from Friday. We hit it in the Globex, so that's now technically not considered an untouched point of control anymore. But it was a Globex touch, and there's always this argument that the Globex doesn't quite count when it comes to things like this. So where I would approach it is just recognize that it's already been tagged, right? If we were to come back down into that area in the RTH, I would still expect some response or reaction there. Also, there's an untouched point of control to the upside, 37.70-ish. Should we get that bullish upside move that we were talking about, that's there. Just remember the short squeeze and the shorts covering is very likely done, right? And Powell's going to be chipping his teeth all morning. So the market is very likely not to make a decision. It's very likely to stick sideways. All right, I mentioned it at the start. We'll bring it back over. Significant moves in gold and in oil. Now, I've seen a little bit of talk on the oil side that it has a lot to do with the president at 2 o'clock talking about this gas holiday tax. But I haven't seen anything on the gold side, right? Just remember, gold is an inflation hedge. The dollar did kind of get bid up a little bit last night, but it's off of those highs, just like the S&P and the NASDAQ are off of those lows. If we're going to get really bearish today, keep your eye on that VIX. We want to see it back above, say, 34 and a quarter. The VIX hasn't been doing its job well lately. We still want to keep our eye on that 34 quarter, maybe 34 flat. The dollar has been a better approximation of global risk. And the fact that we've seen the bonds going up this morning was an interesting development. They've been just oddly out of sync with everything else that's been going on. So you want to keep your eye on today when you're watching the internals and looking for your play is the oil. It really needs to just calm down, hold range, keep the low, not get worse. But we really don't want to see big exaggerated moves to the upside. A slow, easy grind back up into its previous stable levels is really what we want to see. So nothing extreme and definitely not a break below 103. With the bonds, we do want to see this continue to move up, right? Bonds up, yields down. We do want to see that, but easy, nothing extreme. We start seeing those extremes, back away from the positions that you're in and look for the market to really try to shake things loose. If we do see any moves out of the dollar, we want to see it confirmed in the VIX. And we continue to use Bitcoin as a risk on, risk off sentiment indicator. We're not talking anything about a correlated market state between Bitcoin and anything else, just that it is one of the most riskiest assets right now. And if we see it being bid up, if we see traders putting in money in that direction, it shows their bias, right? Their risk on sentiment. All right, so taking a look at the sectors this morning, it really shouldn't be much of a surprise that every single sector is down. Even the ones that are showing that they are in the green, they're only barely in the green, and my benchmark is at least a half of a percentage point. So gold is on that list, which we were just talking about. Other than that, it's bonds, TLT. Now we do have this Keltner channel here, and the bonds are back inside the Keltner after having stayed extensively outside of the range for a considerable period of time. So we're back inside it. We're going to be looking for the next rollover and the next leg lower in those. I'm going to back up and look at some of the S&P legacy sectors or the lack of legacy sectors, right? Because those 9, well, 11, depending on how you want to approach it, they really don't cover the modern world that we live in, right? Like crypto. So when we're looking at crypto stocks, yes, there's like a crypto ETF, and I heard there's even a new crypto short ETF. That's going to be awesome. BITO is the crypto ETF, and then the new short one. Hopefully, I wrote that sucker down. Oh, I have to go get it. It wasn't up yesterday when I tried to look at it, but there's going to be a short crypto ETF, which is just absolutely phenomenal. But it wasn't up yesterday when I tried to look. So we'll be adding that to the crypto list. But a lot of these names are not just crypto, right? This is the basket of stocks that makes up the crypto index for the crypto's futures product on the Smalls exchange. So I just opened it up and took the names out of that list and built the watch list from that. Some of these companies are heavily vested in blockchain. Some of these companies are heavily vested in coin. They own a lot of coin, and then some of these are coins, right? So when we're looking at the S&P and its legacy 11 sectors, it doesn't really provide much insight on things like crypto in this way. So when we're looking at it, we want to kind of get an idea of what's going on in the crypto space. Things like Riot or Coin, or if it's going to be more on the other side, like chips and semiconductors. And so far, everything is really beaten down. But if we're going to see a flip, right, if we do see any kind of rally or reversal, which names would we want to focus on? The EV market is another one. So XOS this morning is up significantly, but that could be just because it hasn't had a morning print and that it's still showing from last night. It doesn't look like it. So it does have a morning print, but there wasn't any volume behind it. It was one single print. So we would just kind of discount that 2% move. And behind that, we've got Liato. Very likely a continuation from that big gap yesterday. But now you can look at it on the daily and see that we're inside day significantly, right? Big gap down, rally back up. It's rocking and rolling. It's making some moves. Just got a whole lot of nothing at the moment. BITI. Thank you, Andrew. I I had a sneaky suspicion that it was that, but I didn't want to say it. Put that sucker in my notes so I don't forget it. Hey, have you seen a chart on it yet? Because when I looked at it yesterday, it wasn't coming up. And when you're dealing with think or swim, sometimes you think maybe it's just think or swim, right? Think or swim. Hey, I love it, but sometimes it really lets me down. Why I have a motto: never trust, think or swim, especially when you're dealing with something new or you're dealing with custom indicators. Sure enough, there it is. All right. So, it's day one, right? Yesterday, first day, it's the very first. This thing is new, right? But I love what it offers us. One of the things when it comes to crypto that really chews me up is how you got all these people who've never traded in their lives. They hear the hype at work and they download some app to trade on their phone, and they can only go one way, up. All they can be is buyers. They can't short it. They can't do anything with it but buy, buy, buy. And then they just get ripped apart. Plus, a lot of the institutional traders can't touch a product if they can't hedge that product. So we've needed something like this for a long time. I'm super excited about it. We just got to let it play out a little bit. Those of you who aren't quite sure what we're talking about, there is a Bitcoin ETF, BITO. If you did want to short Bitcoin, you could just use the options on this thing, right? Go in and, buy a put if that's what you wanted to do. The bid ask isn't that bad considering, it's a $13 market. And, there's some reasonably decent liquidity considering how new the thing is. Sorry, seen a squirrel, got sidetracked. Let me put my crayons away. All right, the pot stocks. When we're talking about diversification, it's not just trying to keep our trades diversified from different products, it's different biases and things that are not doing what the S&P are doing. Because you're not diverse if you're trading Microsoft and Apple and Google and Tesla, and they're all the S&P, right? They're all doing exactly what the indexes are doing. So when we're trying to find that diversity, we want to step into different realms like commodities, treasuries, precious metals. Pot often does whatever the hell it wants to do, and it has no relation necessarily to what's happening in the market. So certainly something to keep our eye on for an opportunity to trade, right? It's not necessarily been a great sector, but that doesn't mean that there aren't opportunities to trade. Nothing really standing out in there at the moment. It's down like everything else is down, but I would be watching for any kind of play in here if I'm trying to avoid high beta plays, right? And thinking about like a fast beta. Beta is a representation of how much a ticker symbol matches the SPX. So a fast beta of 1 would imply that that company you're looking at is going to move almost lockstep with the S&P. A beta of 2, then it's liable to move 2% for every 1% of the S&P. And a beta of 0 would be an almost inverse correlation with the S&P. So if you're looking to gauge or measure the thing that you're trying to trade and compare it to the S&P to get a feel for, are you actually stepping out of that box? Look at the fast beta. If you want to know where to get that, there is an indicator, but I tend to look in the options chain. Just use the drop down under the underlying and look to your far right. It has beta or fast beta. The difference between beta and fast beta would be very similar to the difference between a simple moving average and an exponential moving average. Fast beta is weighing more of the front data than all of the data equally. So that if you look at something like Apple with a fast beta of 1.2, right, it's moving about a quarter of a percent more than the S&P is moving. Commodities aren't looking all that hot either. One thing that's not showing up here today is the oil report. Normally on Wednesday, we get the oil report at 10:30, and it's not showing in here. I'm sure there's some logical reason for it, but it just kind of got my attention, especially with this whole thing going on where Biden's going to be talking today and the holiday price tax and blah, blah, blah. And yet there's no uh, petroleum status report this morning. Now, I haven't had a chance to dig into it since I just kind of caught it, but I would circle back on that. Maybe dig a little into USO this morning and see if there's any post or anything that discusses why there isn't one today. That still makes the pullback, the move that we saw in oil in XL CL If this is because of the gas tax talk from last night and into today, well, we have almost no expectation that they're actually going to get anything through Congress, which would imply that this pullback is just a really great opportunity to finally get in on energy if you weren't already in it, or to get reset in it for another chance, right? For another opportunity to take it long. It doesn't have to be something like oil either, right? Marathon Oil, Dale. I mean, it's a big list. You get into more of your legacy names like Exxon Mobil, Chevron. You can get into some drilling names, which, that's kind of so far away from the refining process. You want to maybe perhaps get a little closer to that. But if this is a pullback that was induced by that news, by that post of the tax, then setting up for some new longs in energy may be a nice play. All right, emerging markets is down significantly. We use this for our global risk on, risk off gauge. Not a surprise, as with the rest of the market, that it's down. Main thing today, guys, is going to be hold the line, right? That we want to see Powell get through today and tomorrow without significantly rocking the boat, and be focused on where our next play is going to be. If this was all short coverings, then we're looking for rejections at the 100-week EMA, because there's a lot of those right now. We need to see the VIX above 39 if we're going to continue this bear market run. We're looking for the S&P, once it breaks structure, to still head down to that 35, 3400 area. Right, so we're looking at the week. So all those rallies from yesterday, a lot of them were just shorts getting covered, maybe a couple of squeezes, and then we're just putting in that next swing low, right? So we're looking for anything that's going to invalidate that pattern. So a continuation to the upside, another big explosive move to the upside might start to invalidate that logic. Otherwise, we're looking for a continuation of chop for at least the next 2 days. That's what I got for you guys. Be careful, be safe. It is I was going to say it's my day to stream, but that's not. Not sure who's streaming today. Hold on a second. Let's see the schedule. It's been that kind of week lately. Already it's been that kind of week. No, it's Jeremy's day to stream. So Jeremy will be streaming in looks like stocks and options. Right?